And it depends on how successful Bitcoin is. Gold and fiat have been able to coexist for many decades. Bitcoin is kind of a faster, harder gold, as long as Jeff Booth would say, as long as it remains decentralized and secure, then it's basically kind of the apex predator of monies. And kind of like how dollars can crowd out developing market currencies, Bitcoin can eventually crowd out the dollar. And, every technology since then, and prior to then even, has been deflationary. Now that is offset by money supply growth. And if anything, I mean, central banks around the world, they want positive inflation. So they try to make sure that their debasement level exceeds deflationary growth we get from better technology. AI represents, the most recent one we have. People debate around the size of it, but I think it's substantial. Harm the asset itself, like something like gold or Bitcoin, but they can say, well, if you own it, we're going to do our best to surveil that fact and tax it and slow it down and add frictions where we can. And so I think it's a very long-term process for something like Bitcoin to 10x or 30x and start kind of being at the scale that would be like a completely viable.
Alden points out that Bitcoin is currently undergoing a multi-decade testing phase. It has already survived the civil war of the block size debates. It has survived the flurry of thousands of altcoins trying to dethrone it. It faces constant scrutiny regarding quantum computing risks and environmental concerns. Even now, we are seeing debates about non-monetary data, like ordinals and inscriptions, being stored on the blockchain. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
And it depends on how successful Bitcoin is. Gold and fiat have been able to coexist for many decades. Bitcoin is kind of a faster, harder gold, as long as Jeff Booth would say, as long as it remains decentralized and secure. Then it's basically kind of the apex predator of monies. And kind of like how dollars can crowd out developing market currencies, Bitcoin can eventually crowd out the dollar. We're talking, orders of magnitude difference here. So Bitcoin, depending on price action, something like a $2 trillion network, you're up against a minimum tens of trillions network, but really when you include all the bond markets and everything, it's more like a hundreds of trillions network. These ledgers, these powers have the ability to tax other assets. They have the ability to declare things legal tender. They can put pressure on liquidity of systems, so they might not be able to, harm the asset itself, like something like gold or Bitcoin, but they can say, well, if you own it, we're going to do our best to surveil that fact and tax it and slow it down and add frictions where we can. And so I think it's a very long-term process for something like Bitcoin to 10x or 30x and start kind of being at the scale that would be like a completely viable power compared to the US and China and these really the biggest currency blocks in the world. But yeah, if it's able to kind of get super big at the same time as you have kind of these long-term fiscal deficit issues really start to increasingly have their problems, and countries have to take more overt actions to try to protect their currency. Things like you see in developing countries, capital controls and yield curve control and kind of this kind of yield suppression that happens. And it kind of, the mask comes off and more people flee to those assets. It can become kind of like there's two separate worlds there. And there's one that's kind of decentralized and, resistant to debasement. And the other one is centralized and increasingly rapidly debasing. I guess my view is that it probably would take quite a while if we reach that phase, and Bitcoin has to be tested in pretty much every way. It's already been tested by the flurry of altcoins. It's always tested by just the long-term risk of quantum and whatever kind of fears people have around the technical sustainability of it. Right now we're obviously seeing discussions around non-monetary data in the blockchain and what, if anything, should be done about that. So it has to kind of go through almost every test imaginable. Governments have tried to ban it, and in some cases pulled the ban back, or the government's own like legal system. Sometimes you have independent courts, and there's kind of money will come in and try to challenge certain bans. And it's this long-term thing that has to go through for decades to test itself to be super viable and resilient, and then grow large enough to challenge some of these really big systems.
What would your portfolio, you know, general percentage recommendations be?
Well, it would depend on the investor, right? So someone who's 25, I'd have different kind of suggestions compared to someone who's 75. It also depends on what their convictions are. If someone's, curious about Bitcoin, that's different than someone who's read 10 Bitcoin books and, uh, you know, can, answer tons of trivia about the thing and has conviction on it, right? So I wouldn't say like, they should have equal percentages of the asset. Also, people have kind of, they have expenses. I mean, there's something, there's like a dozen people that are kind of one way or another reliant on my income and my support in many ways. And so, having like 85% drawdowns of the entire net worth at this phase wouldn't really be warranted. So yeah, and also I'm comfortable with equities and pressing over the long term, and I've of course strongly added Bitcoin since I became interested in it. And for me, partially through just sheer appreciation. So Bitcoin's become a very large percentage. Kind of the initial years that I got interested, I put most of my cash flow toward it, and then when it goes up, 10x or more, that becomes a very big percentage of the net worth. And I never sell cold storage Bitcoin. And so generally speaking, my model portfolios that I kind of just put out for kind of broad, people can look at them and things like that. I put something like a 5 to 10% Bitcoin allocation. And of course, that's saying, okay, many people have a 60-40 portfolio. And it's like, okay, how can we make this less bad? Right? Primarily the bond component. So it's like, well, you can put some of the bond component into gold, and gold has absolutely crushed bonds over the past 5, 6, 7 years. And you can put some of the equity component, the more volatile component, into Bitcoin. Bitcoin has beaten, other than maybe Nvidia, Bitcoin has beaten most equities over this time. And by having some degree of diversification, your portfolio is more likely to go up most years. So, I mean, since like the peak of Bitcoin in 2021, gold has outperformed Bitcoin, kind of surprisingly, for like a now 4-year stretch or so. And so having a little bit of both can help. Now, for my kind of personal allocation, it's much higher than 5 to 10%. Again, partially just because of sheer appreciation and never rebalancing. So it really much depends on the person and their conviction, and their what their needs are, their volatility tolerance. But generally speaking, it's a combination diversification, but then kind of leaning in when you're convicted about something. And for me, that's Bitcoin. That's been precious metals, and then to some extent, it's been certain equities when I want a lower volatility ballast or income from those investments. Before I kind of got convicted on Bitcoin, I generally found a lot of the work that I do in finance to be somewhat depressing, because I would kind of point out the issues. I would see this kind of fiscal dominance coming, see the issues with kind of passive investing and index investing and kind of the decentralization tendencies that all has. And I wouldn't really have a great answer. Whereas once I kind of got convicted that Bitcoin is going to work, that it's basically well designed and it's got the best shot that I've seen for a new system, then in addition to treating it like an asset I own, is also something I poured my time into. So it's something that I like at Ego Death Capital, we invest in startups that are building on Bitcoin, improving privacy, improving payment rails, and making it easier to take self-custody of it, to buy it without kind of, altcoin casino distractions, whatever the case may be, anything that kind of brings utility to the network and makes it easier for people to use the network. And so, I took time to write a book about it, at least partially about it. And it's once you see it, it's kind of like it's hard to unsee. And so people tend to shift more of their capital and more of their time to it if they become convicted, and I'm no exception.
Alden distinguishes between the curious and the convicted. A 25-year-old with a high risk tolerance and a deep understanding of the technology should be positioned very differently from a 75-year-old retiree who relies on fixed income. If you have read 10 books on Bitcoin, understand the code, and hold your own private keys, your conviction allows you to stomach the volatility. You might hold a significant portion of your net worth in the asset. However, for the average person or the model portfolio, a 5% to 10% allocation is the sweet spot.
Well, so all else being equal, any sort of productivity growth in a vacuum is deflationary. So assuming a fairly fixed ledger, if you get much better producing a good or service, the cost comes down. When it used to take like 2/3 of people work in agriculture, because that's how much work it took to feed everyone. But when you have hydrocarbons and then tractors, one farmer can do the work of 20 people, and then it only takes a couple percentage of the population to feed everyone, so that everyone can get off the farm and they can go work in medicine or finance or tech or whatever the case may be. And every technology since then, and prior to then even, has been deflationary. Now that is offset by money supply growth. And if anything, I mean, central banks around the world, they want positive inflation. So they try to make sure that their debasement level exceeds deflationary growth we get from better technology. AI represents, the most recent one we have. People debate on the size of it, but I think it's substantial. In a similar way that kind of in the past several decades, automating manufacturing work, kind of the combination of globalization and automation, dramatically brought down the cost of many things. Then you also had Moore's Law, dramatically bringing down the cost of electronics. So everything ranging from TVs to textiles to plastic toys and everything in between got much, much cheaper, even as we had debasement. Those things have generally exceeded. They've been more deflationary than the money supply growth has been inflationary. So in many cases, they've gone down or sideways in price. AI, basically can automate a lot of white collar work. I tend not to be as super bullish on it as others. The idea that in like 5 years no one has to work or something like that. I think that's pretty severe limitations. But it's getting rapidly better every month, every year. I think there's a lot of kind of like how a tractor can make a farmer do 20 times more work, and a machine can make a manufacturer, technician, and an employee, do the work of 5 people. I think AI can let one accountant do the work of, we'll see how many accountants, but as it gets better, 2 accountants, 3 accountants, 5 accountants, 10 accountants, we'll see. Editors, translators, all sorts of professions can now be so that one person can do the work of what many could do before. That can free them to work on other things. It can also open up societal challenges in that environment, but that is a deflationary component that is offset by money supply growth. And as Jeff would say, the system kind of needs inflation the way it's designed. The debt-based system needs inflation. I think a lot of economists mix that up and they say, well, deflation's bad. But it's specifically in a debt-based system, deflation breaks that system. But if you have a less indebted system, if you have a more equity-focused system, then deflation's good. I mean, who would say they're sad about laptops and TVs getting cheaper over time, or toys getting cheaper, or shirts, basically staying the same price for 20 years, even as money supply is like quadrupled? People like technologically driven deflation. Even the companies that make those things so it's only those that are heavily indebted that don't like it, because their debt kind of goes up in value, and they're short that debt. In the current system, deflation breaks things, but it doesn't break things in all systems, and it just kind of can change what systems work. I think the main one, and I catalog this a lot in Broken Money, is that for centuries, almost every technological innovation we had on money further centralized it. Every friction that existed, they'd solve it with another centralized layer. So if we wanted to send money, we would say, well, we'll both have a bank, we'll have an account at this banker, and we can just tell them to update our ledger, and occasionally we can withdraw or deposit, but instead of doing that every time, we can just tell them to update the ledger. If we're in different, if we're further out, or if we use different banks in different countries, we can have a series of intermediate layers. You can have bigger banks to connect those other banks. You can have central banks connect them. You can have the biggest central bank of all kind of connect the other central banks. And you basically just build this nested series of centralized ledgers, which is super efficient. But then with a stroke of a pen, the people that run the ledger can default on you. They can seize your funds. They can, do all that stuff. And basically, a lot of this was the fact that what we used as money, gold and silver, as kind of durable as they might be, they're slow. Yeah, and so as we kind of entered the telecommunications age, starting with the telegraph and going from there over the past 150 plus years, we've had to kind of find ways to abstract it, move it around quicker on these centralized rails. What Bitcoin represents is a way to kind of move final value without centralization. So it's kind of the first monetary technology that doesn't just kind of build another layer of centralization on what we already have. it kind of runs in parallel from it, kind of fixes the root layer itself, and gives a whole nother path. And of course, when it's super early, it has to be tested, see if it even works over a handful of years. Then you have to see, can it be attacked? Can it be banned? Can it, how robust is it? Now that it's 17 years and almost 17 years and going, it just kind of keeps I think surprising to the upside. What's powerful is that it's just a fundamentally new way of kind of stripping out the importance of the middleman. I don't think it removes all middlemen everywhere, in the sense that it's not something that kind of on one layer scales to everyone. But what it does is it takes the central bank itself, decentralizes that basically. You have kind of gold combined with its own settlement rails, in a sense, digital gold. And then on top of that, it's this open source layer that anyone can build on. They can build L2s, they can build, if they want, custodial situations, anything in between. And people can kind of choose their own layer that makes sense for their specific purpose. Whereas in the current fit system, you don't get to choose. You don't get access to the central layer. You only get access to the layer 2 and above. And it's a permissioned, centralized debasing system. So that's basically what's powerful. It's something that is, has lower supply growth than gold and moves as fast or faster than fiat. And so that's a powerful combination.
And when you talk about Bitcoin in that way, you're talking about Bitcoin in self-custody.
Yes. Yeah. And I mean, I think it kind of like how I've used this analogy before, that when the car kind of got mass produced, it became the symbol of freedom, that you could go anywhere. And, some people are like they can kind of practically build their own car from scratch. They can fix their car. They know how their car works. Other people are, they're more hands off. They might just buy a car and bring it to mechanics sometimes. They might even just lease a car. They don't have their own car. And so people can kind of choose their own adventure for how hands-on they want to be with that, with home ownership, with other things. I think Bitcoin's kind of like that, where it gives the option where people can self-custody and move around their own money without kind of a centralized layer. I think many people, they want reversible transactions, or they don't want to have their entire net worth, stored on seed plates somewhere. So they do want to trust a custodian, or at least they have the option to say, okay, I'll custody half myself and I'll leave half in this other environment if I trust them. I think the main thing is it opens up the option so that, again, people can choose the whole stack itself. Going back to Hal Finney and Nick Szabo and kind of the early stages of Bitcoin, a lot of them would kind of view that, things have to be built on top of Bitcoin, some of which are custodial, some of which are not. But basically, for scaling or privacy purposes, there are benefits to these other parts of the network. But I think the key thing is choice, that people can kind of choose whatever layer, whatever solution gives them the best mix that they're looking for in terms of either self-custody or speed or privacy, different trade-offs at different parts of the stack. And there's not always one right answer for everyone. Even one person can choose multiple parts of the stack that make sense for them. They might have their savings in their own self-custody. They might have, then they might use a Chaumian Mint for private, fast transactions. That's, got a custodial component for, 1% of their Bitcoin, maybe. And, different solutions for different purposes.
This system is efficient, but it relies entirely on permission. With the stroke of a pen, those who run the ledger can freeze your funds, devalue your savings, or block your transactions. Bitcoin is a historic anomaly. It is the first time we have invented a technology that allows for the rapid movement of value without a central intermediary. It essentially digitizes the properties of gold, final settlement, no counterparty risk, and combines them with the speed of the internet. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space, and drop your comments and observations in the comment section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.